Hi, welcome back. This is the second part of my lecture on risk and capital budgeting. Suppose you have a company with three divisions. The company is engaged in the healthcare industry and it has a hospitals division, ambulatory equipment division, and a lab equipment division. Now, you can view the three divisions in the following way. Suppose it also turns out that the market risk of the hospitals division is high, so it's a high risk division. For the ambulatory equipment division, the market risk is average, so it's the average risk division. And as you might have imagined, the lab equipment division is the low risk division. Now, you can calculate like a firm-wide cost of capital for this company. It would be the average of the cost of capital of the three divisions. And you can apply the firm-wide cost of capital for discounting the projects in each of these divisions. However, these are the kinds of errors that you will run into. If you apply the firm-wide cost of capital for discounting the cash flows of the projects in the high-risk division, you'll be using a discount rate that's too low. So the net effect of that will be that you'll end up accepting negative NPV projects. When you apply the firm-wide cost of capital for discounting the cash flows for projects in the low-risk division, you'll be using a discount rate that's too high. So you'll reject some positive NPV projects. And both errors are actually equally costly. You don't want to accept negative NPV projects, but you also don't want to turn down positive NPV projects. So what's a simple way out of this? Right off the bat, you should move away from the concept of a firm-wide cost of capital. Don't think of a firm-wide cost of capital at all. In fact, use a divisional cost of capital to discount cash flows of projects that appear in each division. However, if you move to the concept of a divisional cost of capital, you haven't really made any progress. What if, for example, in the high risk division, you identify a project that's low risk? After all, not all the projects in the high risk division will be of high risk. Likewise, not all the projects in the low risk division will be of low risk. There might be some high risk projects in the low risk division. And finally, just to complete the loop, not all the projects that appear in the average risk division will be of average risk. So ultimately, to solve this quandary, you have to drill down all the way to the level of the project. Move away from the concept of firm-wide cost of capital. Move away from the concept of divisional cost of capital. Think of cost of capital as being applicable to the project. Assess the risk of the project, assess the beta of the project, and arrive at the cost of capital of the project itself. That's the only way to address this quandary.